Many beginners see when traders talk about making 100 pips in the market, losing 50 pips in the market. Good day everyone, I'm OCEEYFX. In today's video, I would like to explain to you what a pip really means. Moving forward, what is a pip? The simple definition of a pip means percentage in points. A pip is the smallest unit used to measure price movement. And what do we understand by this? When you are observing price movements, you should know that when a price moves from a certain point to another point, that's just a pip move. And the persistent move of that price, either higher or lower, is how the pip is being calculated. So what does a pip tell traders? It tells traders how far price moved, how much profit or loss happened. So you becoming or aspiring to be a trader, these are very vital things you don't need to omit and you need to learn. Why do you need to learn them? Let's look at this first example. If you have a chart showing EUR USD and it moves from 1.1000 to 1.1010, that 10 you are seeing at the back is just a 10 pip move because price moved 10 points upward. And look at this example too, because we have different type of pip calculation, especially when you deal with currency pairs. In currency pairs, you see currencies like EUR, USD happening fine, you can understand them. But you see currency like GBP, JPY, EUR, JPY, USD, JPY, it's been calculated in a different way. But it's still understandable if you decide to understand them. Looking at this currency pair, we are seeing GBP, JPY, and it's moved from what? 198.50 to what? 198.20. That's a decreased. So what is the pip difference? It's a 30 pip difference. Then it dropped 30% below. Look, moving forward, if you want to understand this basically, you want to really know what a pip is and know how it's been looked out for in the market. Traders use a pip and they call it's just like a ruler. Let's read this together. A pip is like a ruler traders use to measure market movements, just like how you measure your distance with meters and your weight in kilometers. But in Forex, we use pips. That's just what we use in Forex. We use pips. That's why it's very vital and very crucial that you know this and add it to your knowledge. Important beginner note. This is what I would like us to know, because whenever I'm making a video, I would like to drop a note where you can go back and reflect on. And if you would like me to make a video on how to calculate pips, I can also do that. Just drop your comments and I'm going to see that and make you a video. As you can see on my screen, most currency pairs, 1 pip equals the 4th decimal place. For example, let's look at this, just like how I've said. EUR USD equals 1.1050. That's 1.1050. If it moves to 1.1051, that's 1 pip. But JPY pairs are different. This is what I talked about. 1 pip equals the 2nd decimal place. Let's move forward. And an example of USD JPY, you can see 150.20 moving forward to 150.21. That's a 1 pip increase. So they are similar, but due to the JPY currency, it tends to differ. I hope you understand that. Due to the JPY currency, it tends to differ. Moving forward, let's know why pips matter. Pips help traders measure profit. It helps traders measure losses. It helps traders to set stop loss. It helps traders to set take profit, calculate risk, and without understanding pips, risk management becomes confusing. This is what I want us to understand as beginners. When you don't know how to calculate your pips well, when you are in the market, all you just know is I'm risking $50, I'm risking $20. You should be able to know that yes, this trade, if I'm going to enter this trade, is costing me 100 pips. 100 pips on 0.01 is different from 100 pips on a 1 standard lot. It's different from 100 pips from 0.05. That's why most people tend to blow their account, because they don't understand what this pips actually mean when refining their strategies or trying to take a buy or sell in the market. Moving forward, we can see this real trading example, because I want this to be very realistic, not just theoretical aspects, but also in an aspect whereby you can practice and understand for yourself. If your strategy targets 50 pips and risk 20 pips, your risk to reward becomes easier to understand. I don't know if you get me. And why does this make sense? If you are targeting 50 pips on a trade and are risking 20 pips, then you know that my risk to reward is above 1:2. When you are targeting 20 pips and your risk is 20 pips, you know that your risk to reward, you will be able to understand it and you know that it's not reasonable to target 1:1. And it depends on your kind of strategy. But understanding this pips value will help in any strategy at all you are using, which is, before becoming profitable, every trader must first understand the language of the market, and pips are one of the first words in that language. You won't see any trading circle where you don't hear, I made 100 pips, I targeted 50 pips but hit my stop loss with 15 or 20 pips, and so on and so forth. These are vital terms you need to know. These are vital terms that will help you in your risk management. So I hope this video is very helpful, and I know I've been able to reach out to you that really needs this, because knowing this alone will save you a lot of losses and help you manage your account and also fasten your trading journey. Thanks so much, and I appreciate for watching.